Welcome to the deep dive. When you're trying to figure out the stock market, it can feel like everyone's speaking this other language sometimes.
Absolutely.
So today, we're going to try and decode one of those really key terms, the Relative Strength Index, RSI.
Right. RSI.
Think of it maybe like a speedometer for stocks, showing how fast and, well, how strong the price movements are.
That's a good way to put it. And we've got a great guide for this, a YouTube video from Pushkar Raj Thakur. He's a market educator.
Yeah, he really breaks down the RSI, shows it live on charts too, which is super helpful.
Exactly. So our goal here isn't just, defining it. We want to get into the nuances, how people actually use it, what it might be signaling.
Basically giving you a solid foundation without all the dense jargon.
That's the plan.
Perfect. So
Yeah.
if you've heard RSI thrown around and kind of wondered what it really means, this is for you. We're going to unpack it, see it in action.
And hopefully get a real feel for what it tells us about market momentum.
Okay, so maybe let's start with the basics. Technical analysis. What is it in this context?
Well, the source frames it as, a whole approach for people looking to make decisions in the market.
Right.
And within that approach, there are loads of different tools, indicators. RSI is just one of them, but it's a pretty popular one, a heavy hitter.
Okay, so technical analysis means looking at past prices, volume, that sort of thing, to guess where things might go next.
Uh-huh.
And RSI is one tool in the box. But here's something the video really stressed, and I think it's crucial. These indicators, they suggest things, right? They don't actually confirm them.
That's such an important point. It's not a crystal ball. The video is really clear. No single indicator guarantees anything. It's about probabilities, tendencies.
Yeah, and building on that, the source says smart traders often use a set of indicators, not just putting all their faith in RSI alone.
Makes sense. You want confirmation maybe from different angles.
And interestingly, even with all these fancy indicators, the video emphasizes that just watching the price itself, support levels where it bounces, resistance where it stalls, that's still the most important thing. Price action is king.
Absolutely paramount. Which leads nicely into the live chart demo in the video. This is where it kind of clicks, I think.
Yeah, seeing it visually helps.
He logs into a trading account, pulls up a stock chart, and you see the RSI indicator right there below the price. It makes it much more tangible.
And you see the RSI line, right? It sort of wiggles around between 0 and 100.
Yeah, it's range bound. Gives you that visual sense of the recent buying versus selling pressure.
And now here's where it got interesting for me. The presenter showed how you can actually tweak the settings. Like the default might be 70 for the upper limit and 30 for the lower.
The traditional oversold levels, yeah.
But in the video, he adjusts them to 60 and 40.
Right, and that immediately tells you these numbers aren't sacred cows. They can be adjusted.
That was a bit of a light bulb moment. Because by narrowing that range to 60-40, he suggests that the space between them could be like a wait-and-see zone.
A potential no trading zone, as he puts it. The idea being that the stronger signals, the real opportunities, might come when the RSI breaks out of that tighter 60-40 band.
So if it breaks above 60, that might signal, what, strong buying, an uptrend gaining steam.
Potentially, yeah. Suggests momentum is picking up on the upside. Conversely, if it drops below 40, that could indicate sellers are taking control, maybe the start of a downtrend.
It's like filtering out some of the noise you might get with the wider 70-30 levels.
Exactly, trying to catch the more significant moves.
Okay, so we've seen it on the chart. We know it goes 0 to 100. Let's dig into what it's actually measuring. The source mentioned the standard setting looks at the last 14 days.
Yeah, often the 14-day average of closing prices, that's a pretty common default look-back period. But again, like the levels, that 14 can be adjusted too, depending on your time frame or strategy.
Flexible. Got it. So let's talk about the standard levels first, the 70 and 30. What do they traditionally mean?
Okay, so if the RSI dips below 30, that's generally flagged as oversold.
Meaning the stock's been sold off too much, maybe it's potentially cheap.
That's the traditional interpretation. It might be undervalued, and buying pressure could step in, especially if the price finds a support level down there. Could lead to a bounce.
And the flip side? Above 70.
That's the overbought zone. Suggests maybe the buying has been too aggressive, the stock could be overvalued.
So, potential selling pressure coming? Maybe the price hits resistance and pulls back?
That's the classic take, yes. Could lead to a price decrease after hitting some resistance.
But now, thinking about the video's adjusted 60-40 levels, how does that change the interpretation? A break above 60 is then seen as a potential buy signal.
That's how the presenter frames it, yeah. A possible buy, expecting maybe the price keeps climbing until it hits some resistance. And he links this to chart patterns, too, like a potential double top.
Ah, okay. So layering patterns on top of the RSI signal. What's a double top again? Called it an M pattern.
Yeah, an M shape on the chart. Price goes up, pulls back, goes up again to roughly the same high point hitting resistance, but fails to break through and then heads down again. That failure at the second peak can be a sell signal.
Like hitting a ceiling twice.
Mm.
Got it. So conversely, if the RSI breaks below that modified 40 level,
That's suggested as a potential sign of a downtrend strengthening, expecting maybe further falls until the price finds support. And here he introduces the double bottom or W pattern.
makes sense. Mirror image, price goes down, bounces, goes down again to a similar low, finding support, fails to break lower, and then heads up.
Exactly, a W shape. That second successful test of the low suggests buying is overcoming selling. So RSI breaking below 40, maybe forming a W pattern near support, that could be seen as a potential buy opportunity.
Okay, so RSI gives clues about momentum, direction,
Yeah.
but it's clearly not infallible. The source really hammered on the danger of only using RSI. Right?
Oh, absolutely. Critically important. Don't trade on RSI alone. And this is where the concept of divergence comes in, which is, well, quite interesting, but also highlights why you need more context.
Divergence. Okay, that's when the price and the RSI are telling different stories.
Pretty much. They're moving in opposite directions. Let's take bearish divergence first. Price keeps making new highs, higher highs. Looks bullish.
Yeah, sounds good.
But at the same time, the RSI indicator is making lower highs. It's not confirming those new price highs.
Ah, so even though the price is inching up, the momentum behind those moves is actually weakening, according to RSI.
Precisely. It's a potential warning sign. It indicates that the upward trend might be running out of steam and a downward move could be coming, even though the price itself still looks strong for the moment.
That's counterintuitive, but powerful.
Yeah.
And the video had that analogy, the balloon.
Yeah, the presenter used that visual, said the widening gap between the higher price peaks and the lower RSI peaks looks like the open mouth of a balloon, which, means bear in Hindi, a memory aid for a bearish signal.
Clever. Okay, so what about bullish divergence? The opposite.
Exactly. Price is making new lower lows, looks bearish, downtrend continues.
Right.
But the RSI is making higher lows. It refuses to confirm those new price lows.
So price is falling, but the selling momentum is actually easing up.
That's the idea. It suggests the downward pressure might be weakening, potentially setting up for an upward reversal. The analogy used was like a bull with a smaller gap, contrasting with the bear's open mouth.
Okay, so divergence can be like an early heads up that the trend might be about to change.
It can be, but again, it's not guaranteed. Divergence can persist for a while, or it might not lead to a reversal at all. It's just another piece of the puzzle.
Which brings us back to, you can't just use RSI by itself.
Absolutely not. The source is really strong on this. Combine it with other indicators, and crucially, combine it with looking at the actual price chart. Those support and resistance levels are key.
The presenter even shared a personal example, didn't he? An investment where RSI crossing 60 was a factor, but definitely not the only factor.
Yeah, that real-world example helps. It shows it's part of a bigger picture, more holistic analysis, not just RSI hit X, so I buy.
And in that example, I think he mentioned a double top forming after RSI crossed 60, leading to a dip, but then the price found support around that 60 level.
Right, it shows the interplay. The initial signal, then a pattern, then support holding. It's dynamic.
It really is. The video also quickly mentioned something about a straddle strategy in high volatility.
Just a brief mention. Buying both a call and a put option, it's a more complex strategy for when you expect a big price move but aren't sure which way. It just kind of reinforces that you need to consider the overall market conditions too, not just indicator readings in a vacuum.
Makes sense. Okay, another angle, time frames. RSI isn't just for one type of chart, is it?
No, not at all. You can apply it to pretty much any time frame. Short term, like 5-minute, 15-minute, 30-minute charts for day trading.
All the way up to daily, weekly, even monthly charts for longer-term investing or swing trading.
Exactly. And what's really important to grasp is that the meaning of an RSI reading can change depending on the time frame you're looking at.
How so?
Well, say RSI looks really high, maybe over 70 on a 15-minute chart. Looks overbought, right?
Yeah.
But if you zoom out to the daily or weekly chart, that same stock might be in a powerful long-term uptrend, and the RSI might just be showing healthy momentum, not necessarily an imminent crash.
Ah, okay, so context is everything. What looks overbought short-term might just be strong momentum long-term.
Precisely. So for longer-term decisions, like the example used in the video about maybe investing in Reliance,
Sophisticated stock example, yeah.
the advice was clear. Look at the monthly and weekly charts too. Don't just base a long-term decision on a daily or intraday chart's RSI reading. Get the bigger picture.
And the analysis in the video, looking at reliance on those longer charts, noting RSI broke 60 on the weekly, but then identifying potential resistance higher up around 73, 75, and support maybe back near 50.
Yeah, it beautifully illustrated combining the RSI signal, breaking 60, with identifying those crucial price zones, support and resistance, on the relevant time frame.
So looking at RSI across multiple time frames and always linking it back to support and resistance, that gives you a much richer, more nuanced view.
Definitely. It helps you build what traders call confluence, when multiple signals across different time frames or indicators point the same way. RSI tells you about momentum, price action tells you about key levels. Together, they're much more powerful.
Okay, that feels like a good place to wrap things up. Let's try and nail down the key takeaways from this deep dive into RSI based on that Pushkarash Thakur video.
All right, first off, RSI. It's a momentum indicator, 0 to 100 scale. Helps spot potentially overbought or oversold conditions.
And while 70-30 are the classic levels, remember they can be adjusted like the 60-40 example we saw. It's not set in stone.
Good point. Second, RSI can give potential buy-sell signals, either by breaking out of those defined ranges, like 60-40, or through divergence when it disagrees with the price action.
Yeah, remember the bearish balloon mouth and the bullish divergence. Keep those in mind.
But third, and this is probably the biggest one, don't use RSI in isolation, ever.
Please don't.
Combine it with other tools, especially price action. Where are the support and resistance levels? What patterns are forming? That integrated approach is key.
Absolutely.
Yeah.
And finally, look at RSI across different time frames, daily, weekly, monthly. It gives you that much needed broader context for the momentum signals.
That really covers the main points from the source.
It does. So here's something to maybe chew on now that you've got this foundational grasp of RSI.
How it measures momentum.
Yeah, think about how combining that insight with what you might already know about spotting support and resistance on a chart could maybe offer a sharper view of what the market's doing.
It's a powerful combo. And it leads to the next question, really. What other indicators could you potentially layer on top of RSI and price action to get an even clearer picture?
That's a great thought to leave things on. Exploring technical analysis is definitely a journey, not a destination.